Thousands of people woke up one July morning to find their bank simply didn't exist anymore. Not closed for the day, gone. Seized overnight by regulators in 7 countries in the same coordinated hour. The bank was BCCI, the Bank of Credit and Commerce International. And what regulators found inside wasn't a struggling institution. It was a nearly 20-year con dressed up as one of the fastest-growing banks on Earth. BCCI was founded in 1972 by a Pakistani banker named Aga Hassan Abedi, with backing from Bank of America and the ruling family of Abu Dhabi. The pitch was ambitious. A bank built for the developing world, headquartered nowhere in particular, answerable to no single regulator. It grew fast. Within a decade, it was operating in dozens of countries, courting deposits from governments, businesses, and ordinary savers who saw a global brand and assumed it meant global oversight. It didn't. BCCI was registered in Luxembourg, run out of London and Karachi, and audited in pieces by different accounting firms in different countries, none of whom saw the whole picture. That fragmented structure wasn't an accident. It was the entire business model. As long as no single regulator or auditor could see everything at once, BCCI could keep loans that were failing off the books, invent transactions to plug the gaps, and quietly cover it all with fresh deposits coming in the door. By the early 1980s, one of BCCI's largest borrowers, a shipping conglomerate, was already sliding toward bankruptcy. Instead of writing off the losses, BCCI kept pumping money into the failing company and falsifying the books to hide it. That single decision metastasized. Fake loans covered old fake loans. Numbers on paper stopped reflecting anything real. But the hidden losses were only half the story. Behind the scenes, BCCI wanted something even more valuable than deposits: a foothold inside the United States banking system. American regulators had already rejected BCCI's attempts to buy a U.S. bank outright, so Abedi found another way in. Using Middle Eastern investors as front buyers, BCCI secretly financed the takeover of a Washington banking company called First American Bankshares, all while publicly claiming no ownership stake at all. To make the deal bulletproof, BCCI brought in one of the most respected men in Washington, former Defense Secretary Clark Clifford. Clifford and his law partner took over as chairman and president of First American, personally assuring federal regulators that BCCI had no control over the bank. For years, that assurance held. Behind it, BCCI was allegedly involved in hiring First American's executives, directing its acquisitions, and quietly steering the very bank it claimed to have no ties to. The cracks became impossible to ignore in 1988, when a criminal trial in Miami exposed BCCI executives helping Panama's dictator, Manuel Noriega, launder drug money, some of it moving directly through accounts at First American. Investigators eventually alleged BCCI had served as a personal banker not just for Noriega, but for a rotating cast of dictators and strongmen looking to move looted government money out of reach, all hidden behind a bank that looked, from the outside, entirely legitimate. For years, the warning signs kept piling up and kept getting ignored. Whistleblowers raised concerns. Regulators in different countries compared notes and found inconsistencies. In 1988, American investigators indicted BCCI-linked individuals in a sting operation targeting money laundering for drug traffickers. It should have been the end. Instead, BCCI weathered it, restructured, and kept operating, because unwinding a bank with deposits from governments and families across dozens of countries was a mess nobody wanted to own. The real reckoning came from the numbers themselves. In 1990, the Bank of England grew suspicious enough to order an outside audit. What that audit found was described in blunt terms: evidence of massive, systemic fraud, dating back years, possibly to the very beginning. The bank's own liquidators later concluded BCCI may never have turned a genuine profit in its entire 19-year existence. On July 5, 1991, regulators moved. Simultaneously, across 7 countries, offices were raided, records seized, and BCCI's doors shut for good. It was, at the time, the largest bank seizure in history. What was left behind was staggering. Total liabilities were estimated near $10 billion. Realizable assets covered barely a tenth of that. Somewhere between $9 and $10 billion had simply been lost or stolen, vaporized into fake loans, phantom transactions, and money that had been laundered clean out of the system. The fallout in Washington was just as ugly. Clark Clifford, once one of the most trusted statesmen in American politics, was indicted alongside his law partner for concealing BCCI's secret ownership of First American. Both maintained they'd been deceived just like everyone else. The case became a national scandal over how a foreign bank, tied to drug money and dictators, had quietly bought its way into the heart of the U.S. financial system, with the help of some of the most powerful names in the capital. The people who paid the real price weren't the executives or the lobbyists. Thousands of depositors, small businesses, working families, and even the government of Abu Dhabi, which had backed the bank from the very beginning, lost money that, in many cases, took years or decades to partially recover. Court-appointed liquidators spent the better part of 2 decades clawing back funds for creditors, eventually recovering a majority of what was owed, but only after a fight that dragged on for more than 20 years. In the aftermath, investigators found BCCI hadn't just been sloppy. It had allegedly moved money for arms dealers, dictators, and criminal networks, hidden behind a structure built specifically so no regulator could ever see the whole truth. The press gave it a nickname that stuck: the Bank of Crooks and Criminals International. Decades later, regulators still point back to BCCI as the textbook case for why complex, borderless financial institutions need borderless oversight, a lesson that keeps resurfacing every time a new global collapse makes headlines, from Enron to FTX. If you want the full breakdown of how frauds like this get built brick by brick, that's exactly what I cover every week. Subscribe for more.